Hi, my name is Paul, and welcome to episode 17 of the monthly stock portfolio series, where I invest $100 of my own money each month into Canadian securities. In last month's video, I went through Knight Therapeutics' fourth quarter earnings results and conference call, and afterwards I decided to sell half of my stake in the company to buy a new stock for the portfolio. As for this month, I'll briefly be covering both MTY and Morguard's first quarters, as well as any other news that pertain to the portfolio's holdings. In addition to that, I'll be showing you exactly how I'm going to be investing this month's $100. And just like last month, there will be some heavy selling going on within the portfolio. Also, I have a surprise change that I'm going to be implementing to improve the quality of the series, so this is an episode that you definitely don't want to miss out on. But before jumping right into things, you should know that at any point you can go into the description box of this video to check out the goals and rules that I've set out for investing in the monthly portfolio. Alternatively, you could watch me go through all of that in the first episode of the series, and a link to the playlist starting at episode 1 is also available in the description box. With that out of the way, let's get right into the news. First up, we had MTY's first quarter earnings, which were released on the 12th. This marked the first full quarter of MTY's ownership of the barbecue holdings brands, and this was also the first quarter wherein Wetzel's Pretzels contributed to MTY's operations. This led to huge quarter-over-quarter revenue growth, but acquisitions aside, MTY still had good organic revenue growth across the majority of its operations. Now, in the previous quarter, operating expenses were growing at a faster pace than the revenues, but in this quarter, we're starting to see a reversal of that trend, which is really good news because if this continues, there will be more profit for the company. Plus, some of these operating expenses are one-time costs associated with the recent large acquisitions, so that hints towards even more positivity for the next quarter. Taking a look at the free cash flows, MTY did underperform my expectations, but for a pretty good reason. See, on the conference call, we learned that as part of the Wetzel's Pretzels deal, MTY must build 3 new Twisted by Wetzel's locations, which costed about $7 million in the quarter. But without these building costs, the company's free cash flow would have been well above the free cash flow generated in last year's first quarter. Plus, the management fully intends to franchise these locations out once they've been fully constructed, which should recoup all of the costs and begin to generate income for MTY. So, despite the lower free cash flows, for me, this was actually a bit of a hidden bright spot in the quarter. As for the debt, the management showed that taking care of the debt taken on from recent acquisitions is truly a top priority, by paying off $29.5 million in this quarter alone. Noting that there is still over $827 million to go, but thanks to some crafty refinancing through the purchase of an interest rate swap and swap option, MTY was able to lock in $235 million of previously variable rate debt at rates between 3.3 and 3.5% for a 3-year period. This means that even if interest rates increase, the interest rate on that portion of the debt will not. Now, this is a very simplistic explanation of how these swaps actually work, but I do have a more in-depth video on MTY's earnings results where I explain things in much more detail, so feel free to check that out for more information if you're interested. Another bright spot for the quarter was that net locations saw below average turnover for Q1, with net closures of only 39 locations. And on the conference call, it was explained that the first quarter historically has the largest amount of franchisee turnover. So, given that context, this seems pretty good. Lastly, the management believes that the economic headwinds that have been facing the company are starting to subside, and that the future trends are encouraging. So, all in all, I thought this was a pretty good quarter for MTY, with a few things going quite a bit better than I'd expected. And that was just about everything out of MTY this month. So, let's head over to the Morguard North American Residential REIT's first quarter earnings, which were posted on April 25th. And this quarter, I decided not to make a dedicated video on Morguard's earnings because it was just another solid quarter out of the REIT with only a couple of noteworthy things happening. To start us off, the average monthly rent per unit continued to rise on both sides of the border, and occupancy appears to be plateauing at about 98% in Canada and 95% in the United States. So, as should be expected when rents are higher and occupancy is strong, there was more profit, and the funds from operations per share which is generally the best measure of profit for a REIT, came in at about 39 cents for the quarter. That said, once I adjust out the abnormalities like foreign exchange related gains and increases from tax deferral strategies, the adjusted FFO per share is actually a bit closer to 36 cents. But next quarter, we can probably expect even more FFO growth since the colder season is finally starting to come to an end. And this means that more people will be looking to rent, which should lead to increased US occupancy rates. Also, on the conference call, it was revealed that turnover on tenant apartments in Canada is achieving 22% AMR increases. So there's a lot of real market FFO growth that is capable of occurring in the Canadian market as well. Now, in this quarter, the REIT did acquire the remaining 50% of the Fenestra building at Rockville Town Square for about $143 million. Previously, I thought that this purchase would be going towards deferring the taxes owed on property sales that took place in prior quarters. But instead, it looks like the REIT will be using the more recent purchase of the Xavier building in Chicago for deferring those sales taxes. So I'd imagine that the Fenestra purchase was not a valid candidate for the 1031 exchange due to the fact that the REIT already owned a partial stake in the property. Either way, from the conference call, we now know that the REIT is no longer looking to make any more acquisitions or dispositions for the time being. And instead, the management will be looking to buy up shares by chipping away at their daily maximum purchase allowance under the normal course issuer bid. So far, the REIT has already repurchased over 195,000 units for about $3.5 million in the quarter. And without more acquisitions on the horizon, we should be seeing more capital being deployed into buybacks. As of the quarter's end, the REIT has about $132 million of liquidity, as well as $211 million of unencumbered assets. So that amount right there would easily be able to max out the REIT's allowance under the NCIB. Although $50.5 million of that liquidity is variable rate debt that probably should be avoided in the current interest rate environment if possible. As for how the debt profile looks, the REIT is at relatively normal levels of indebtedness, with its average mortgage rates and average term to debt maturation also in line with what is historically normal. And the last thing that I want to cover here is probably the only surprise of the quarter, which was that the REIT's property values actually increased, which pushed the tangible book value per share up to $45.51. Meanwhile, I was fully expecting this number to continue declining alongside median home prices, but it looks like the quality of the properties and their locations are allowing the REIT's net asset value to hold up much better than average, which is great to see. Though it's still a bit early to be celebrating, since this is just a one-quarter result, and flukes do tend to happen occasionally. All that being said, I was very happy with the Morguard North American Residential REIT's first quarter results, even though there wasn't all too much to report back on. A bit later on in the month, we received notice that GoEasy will be reporting their Q1 earnings on May 9th, with the conference call to be held the next day on the 10th. And to finish off the news segment for this video, Knight Therapeutics will also be reporting their earnings and holding a conference call on the 11th. Now let's take a look at how the holdings performed throughout the month of April. And here's where the surprise that I hinted at in the video's intro comes in. I created these new slides that present important information in a much more visually appealing and less cluttered way. So now, hopefully, you won't have to squint to find the data point that I'm talking about on a spreadsheet that's already full of data. That having been said, I highly doubt that these slides are fully optimized to your experience. So after the video is done, feel free to leave me a comment letting me know what I should change, add, or remove to make these slides even better for you. Or if you just want to let me know what your opinions are on the changes, whether you do or don't like them, that's cool too. Anyways, starting with the worst performer, last month I picked up nearly one full share of GoEasy at a price point of $94.65 per whole share. And this was on the back of regulatory news that made the share price look like it took a bad step off a moderately sized cliff. As it would turn out, the drop wasn't quite over and done with, and the shares tumbled even further, ending the month at $88.55. This puts the current value of my month's purchase at $88.29, which is a decline of 6.44% this month. Thankfully, GoEasy is still a small position in the portfolio, and so I'll be looking forward to accumulating some more shares at these low prices. My next worst performer was MTY Food Group. Last month, I purchased a little over a third of a share for $60.94 per whole share. And despite my positive outlook on the company's earnings, the share price ended the month at $57.64, which is a drop of 5.42%. Despite the big drop, I still can't complain too much here, since I love getting some cheap prices on a great company like MTY, which makes up roughly 16% of the monthly portfolio. Next up was Knight Therapeutics, which so far is the first and only company that I've sold shares of in the monthly portfolio. Last month, I sold 17 shares for $4.62 each, and this was because on the company's fourth quarter conference call, it was revealed that there were some serious competitive threats on the horizon that called into question the validity of my original investment hypothesis. Now, if you want the full breakdown for all of my reasons for selling, then you should probably check out last month's video for the full story. Noting that, the sale netted me $78.54 in cash, and since then, the share price has increased by about 1.3% to $4.68 per share. So if I'd waited a month to sell those shares, I would have made an extra $1.02 from the sale. But given what I know now, I believe that there are better opportunities in the market, so I'm not going to get caught up about the dollar that could have been. Thankfully, Knight Therapeutics is the smallest position in my portfolio, which is the way that it should be since Knight is the company that I believe will be the least likely to provide strong long-term returns. The last, largest, and best performer for the portfolio this month was the Morguard North American Residential REIT. At the start of April, I purchased 4 shares of the REIT for $16.94 each, but throughout the course of the month, the price of these shares declined by about 4 cents. That said, thanks to Morguard's dividend, and Morguard making up over 73% of the portfolio, I was able to earn an additional $3.84 in distributions, which boosted the 0.2% loss up to a gain of about 5.43%. And just like MTY Food Group, I was very happy with Morguard's earnings this quarter. Plus, the discount appears to be as strong as it ever has been for the REIT. So you're definitely not going to catch me complaining about getting even more shares for a bargain price. As the month would turn out, I sold a large chunk of what would go on to be my second best gainer and used the cash from that sale to buy what turned into my worst loser. So, to say the least, the return on April's invested capital was not too great. In fact, even when accounting for the dividends, my $103.60 finished the month at a market value of $99.09, which represents a loss of 4.35%. Unsurprisingly, my results underperformed all of the benchmarks this month, but the Global Value ETF made it a pretty close call, hitting a loss of 3.87% in April. The next worst performer of the group was the S&P 500, which lost about 0.4%, and that was followed by the two best performers, the Canadian Large Cap ETF and the Canadian All Cap ETF, both of which received hearty quarterly dividend payouts that boosted their total gains into the 15% range for April. But if we control for the dividends, then these two had much more moderate gains of 0.73% and 0.42%. Taking a look at the entirety of my monthly portfolio's performance since inception, between January 2022 and May 2023, so far I've invested $1,628.10 in personally contributed capital and dividends. And as of the market's close on May 4th, 2023, the value of my portfolio is sitting at $1,572.86, which is a loss of $46.22 or 3.39%. Obviously, this is pretty far from ideal, since the goal of investing is generally to make money, not lose it. That said, my largest percentage losers are my smallest positions. And as I've been saying throughout the series so far, we're still in the very early days of the portfolio, so variance is definitely still playing a huge factor here. And this graph will highlight that perfectly, since it shows exactly how much was gained or lost net of contributed capital. Taking a look at the green line, which tracks my portfolio, you can see that over the past couple of quarters, there have been some very big swings, going from below break even to way above my monthly goal line, and then all the way back down to where the portfolio currently sits today. But in spite of all of these recent big jumps, not much has really changed in my investment style or the stocks that I hold. In fact, last month I made the biggest change to the portfolio so far by selling a bunch of shares in one company in order to buy a completely new company. Yet, if we go all the way through the portfolio's monthly performances, April represented the smallest 1-month move in the portfolio to date. And I think that this presents a very important lesson, in that looking at a snapshot of a portfolio at any given time isn't necessarily a good indicator of whether or not good investment decisions have been made. Take for instance the Global Value ETF. From month 9 up until month 14, it looked like the absolute best portfolio to be invested in. Meanwhile, the S&P 500 looked like the absolute worst portfolio to be invested in. But just 2 months later, and it's a completely different story. That said, the notion that either of those two stories have completely played out is just as silly now as it would have been 2 months ago. So instead of getting emotional over the changes in share price, it's a much better idea to try and desensitize yourself to the waves of market sentiment. You'll almost certainly be better off following rational long-term expectations for the investments that you hold. That means that when a big change in price happens, ask yourself if your original investment hypothesis has actually changed in a meaningful way by whatever recent news may be affecting how others are valuing shares. Then, if things have changed, ask yourself how much they've changed. And finally, ask yourself what would be the most reasonable response. Last month, I asked these questions myself, and afterwards I decided to sell off half of my stake in Knight Therapeutics in response to a new wave of competition entering the branded generic drug markets. These competitors were expected to have a negative impact on short and medium-term earnings, but more importantly, these sorts of competitors that I'd previously been ignorant to are apparently a fixed part of the business landscape in the branded generics sector. This means that every few years, I could expect that a new wave of competition would be likely to try their hand at crossing Knight Therapeutics' competitive moat. Also, these competitors would almost always be able to apply enough pressure to cause some returns to be lost. This unforeseen threat to the business revealed both a greater risk to my invested capital and lower expected future rewards. So, after thinking a little bit longer on my options and the company's prospects, I've decided to sell off my remaining stake in Knight Therapeutics. This will leave me with the cash from the sale, in addition to the $103.85 in contribution, dividends, and remaining cash from last month. With this money, I'm planning on buying my usual 4 shares of the Morguard North American Residential REIT, and the remaining cash will be split evenly between MTY Food Group and GoEasy. And in the future, I do plan to keep my stake in MTY larger than GoEasy. This is because, even though I believe GoEasy has a much better reward potential over the long run, I'm also aware that GoEasy carries greater risks for devastation of capital than MTY. Okay, I'm in the account now. It's May 5th, and there's $103.85 to invest. But before we invest it, let's sell off the remaining shares of Knight Therapeutics, which we have 17 shares of. So we're going to sell that. Okay, and now we should have $80 additional dollars to invest. We have $183.92. So let's start with our Morguard shares. We're going to buy 4 of those. Okay, so we have $115.52 left. If I'm splitting that evenly, that's $57.76 per company. So we'll start with MTY, and we'll switch this to a fractional buy, $57.76. And then there's another $57.76 for GoEasy. Okay, so there's no more money left to invest this month, but the orders aren't quite in, so I'll see you in just a second, and for you it'll be no time at all. Okay, I've officially received confirmation that I've sold the remaining 17 shares of Knight Therapeutics for $4.71 each. Then I purchased 4 shares of Morguard for $17.10 each. Next, I received 0.973 shares of MTY Food Group at a cost basis of $59.36 per whole share. And finally, I received 0.6248 shares of GoEasy at a cost basis of $92.44 per whole share, which left no cash left over at the end of the month. So, as of the market's close on Friday, May the 5th, the portfolio holds 72 shares of the Morguard North American Residential REIT, worth about $1,247, roughly 5.34 shares of MTY Food Group, worth a bit more than $318, and about 1.62 shares of GoEasy, worth a smidge over $150. And until I receive dividends this month, there will be no cash in the portfolio. Speaking of dividends, only Morguard paid a distribution during the month of April, and in total I received $3.84 from the REIT. Unfortunately, this just prices us out of a 10-pound sack of yellow onions, so we'd probably be most efficient by buying a pound of chicken leg quarters and this gardening set that's over 90% off. That way we might be able to get some gardening gigs to pay for the rest of our month's expenses, because we're nowhere near able to cover the cost of living, at least with our dividends. But bit by bit, we are slowly starting to get there. So far, the total cumulative dividends received has just passed $30 for the first time, and next month is projected to be the largest payout yet, with $4.08 coming in from Morguard and $1.09 coming in from MTY Food Group, for a combined total of $5.17, which will be a new record for the most dividends received in a single month, as well as the largest month-over-month distribution increase yet. Plus, if I were to just leave the portfolio as it stands and collect the dividends in cash for the next full year, assuming no changes were made, I could expect to receive $63.41, which is a 10.9% increase from last month. And this means that the monthly portfolio's yield on contributed capital is now up to 3.73%. And before you know it, the annual dividends that can be expected will be over $100, which will essentially provide us an additional month of contributed capital each year, and it will only grow from there. But that is all the time that I have for this episode. So before you leave, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who might also benefit from it. Thanks for watching all the way to the end, and enjoy the rest of your day.